Week 13. Introduction of taxation. What is taxation? Taxation is the inherent power of the state to impose and collect enforced contributions from persons and properties within its jurisdiction for public purposes. It is not based on contract or agreement, but on law. Every citizen and resident is required to contribute a portion of their income or property to support the government. Taxes are mandatory. Once imposed by law, payment becomes a legal obligation. Failure to pay taxes may result in penalties, interest, or even criminal liability. This shows that taxation is a compulsory contribution and not voluntary. The main purpose of taxation is to generate revenue for the government. The money collected from taxes is used to fund public services such as education, healthcare, infrastructure, national defense, public safety, and social services. Without taxes, the government would not have enough funds to operate and provide services to the people. Aside from revenue generation, taxation also has other purposes. Regulatory purpose. Taxes can regulate certain activities. For example, high taxes on cigarettes and alcohol discourage excessive consumption. Redistribution of wealth. Through progressive taxation, higher income earners pay more taxes. This helps reduce income inequality. Economic control. The government may adjust tax rates to control inflation, encourage investments, or stabilize the economy. The implication of taxation is that individuals and businesses must allocate part of their earnings to comply with tax laws. While it reduces disposable income, it supports public welfare and national development. Taxation reflects the relationship between the government and its citizens. People contribute financially, and the government provides services in return. Lifeblood doctrine and its implication. The lifeblood doctrine states that taxes are the lifeblood of the government. Without taxes, the government cannot survive or function effectively. Just as blood sustains human life, taxes sustain government operations. This doctrine emphasizes the importance of tax collection. Because taxes are essential, the government is given wide authority to assess and collect them. Courts generally support the government in enforcing tax laws to ensure continuous revenue flow. Implications of the lifeblood doctrine include: taxes are indispensable. Government operations depend mainly on tax revenues. No injunction against tax collection. As a general rule, courts do not stop the collection of taxes because it may disrupt public service. Strict enforcement. The government has the power to investigate, assess deficiencies, and impose penalties on tax evaders. However, while taxation is powerful, it is not unlimited. The government must still follow constitutional and legal limitations. Taxes must be imposed for public purpose, must be uniform and equitable, and must follow due process of law. The lifeblood doctrine reminds citizens that paying taxes is a civic duty. It ensures that the government can maintain peace and order, build infrastructure, and provide essential services. Fundamental principles surrounding taxation. Taxation is governed by certain fundamental principles to ensure fairness and legality. 1. Fiscal adequacy. Tax systems must be capable of raising sufficient revenue to meet government expenditures. The government must collect enough funds to support public services and national development. 2. Theoretical justice. Ability to pay principal. Taxes should be based on a taxpayer's ability to pay. Those who earn more should contribute more. This principle promotes fairness and equity in taxation. 3. Administrative feasibility. Tax laws should be clear, convenient, and efficient to administer. Collection must not be too costly or complicated. The system should minimize tax evasion and corruption. 4. Uniformity and equity. Taxation must be uniform. Persons in similar situations should be taxed similarly. Equity means fairness in tax burden distribution. 5. Public purpose. Taxes must be imposed only for public purpose. The government cannot collect taxes for purely private interests. 6. Non-delegation of taxing power. As a general rule, the power to tax belongs to the legislative branch and cannot be delegated, except in specific cases allowed by law. These principles ensure that taxation remains just, effective, and aligned with constitutional standards. Concept of tax amnesty and condonation. Tax amnesty. Tax amnesty is a government program that allows taxpayers to settle unpaid taxes with reduced penalties or without criminal liability. It is usually granted through legislation. Under tax amnesty, taxpayers are encouraged to voluntarily declare previously undeclared income or unpaid taxes in exchange for relief from penalties and prosecution. The purpose is to increase revenue collection and give taxpayers a fresh start. Implications of tax amnesty: encourages voluntary compliance, increases government revenue, reduces tax evasion cases, and promotes transparency. However, frequent tax amnesty may discourage honest taxpayers because it may appear unfair to those who regularly pay taxes on time. Tax condonation. Tax condonation refers to the forgiveness of tax liabilities, including penalties and interest. It is usually granted for specific reasons, such as financial hardship, natural disasters, or government policy considerations. Unlike tax amnesty, which applies to a group of taxpayers, condonation may apply to specific cases or circumstances. Implications of tax condonation: provides relief to financially distressed taxpayers, helps individuals or businesses recover from economic difficulty, and supports economic stability in times of crisis. Both tax amnesty and condonation are tools used by the government to balance revenue collection with fairness and economic realities.